Good morning, Alex Woods here, financial mis-selling litigator and legal beagle supremo to the insolvency sector. Welcome to a bright and bountiful new year, and hopefully a prosperous new year, 2014. This is the first posting that I've done since the one that I did just before Christmas, which is like a bumper edition full of stats and colourful pie charts. Please do challenge me on those figures on info@redwoodlegal.co.uk, or comments on the site itself, or indeed on LinkedIn, on my brother's insolvency PPI insolvency group on LinkedIn, because I'd love to be challenged on this. Now, I'm just going to this morning, in a no more than a 10-minute video, run through 5 areas of updates that I think that insolvency practitioners might be interested in knowing about, insofar as financial mis-selling and insolvency is concerned. So, now, I'll just run through what the updates are, so that, and I'll do them in order so that you can dip into the relevant section. The first thing I'm going to do is simply review the stats on PPI in insolvency, in bankruptcies and in IVAs. I'm then going to talk about an innovation that I've been pioneering with a claims management company that I have a very close association with in Oakham. Thirdly, I'm going to talk about my business and my business structure in the third section of this video bulletin, and the way things have moved on in that front. Fourth, I'm going to talk about interest rate swaps. And finally, I'm going to talk about the guidance note and address the issue of obligations insofar as insolvency practitioners are required to process financial mis-selling products. Okay, so the first thing is the stats. It's remarkable how 3 years ago I met with a very experienced consumer credit solicitor who told me that you're going to find that there are 3.2 mis-sold payment protection insurance products in your IVAs. And now that I've worked with two law firms, and now I'm running a unit in conjunction with this claims management company, Maple Leaf Financial, that it's remarkable how that figure has been borne out. And indeed, the value of a PPI claim within an IVA has also been borne out, and it is approximately, actually it's a little bit higher than I originally envisaged. It's about £2,000. For bankruptcies, the figure seems to be lower for some reason. There's only about 2. You've got about 10 items of debt in any IVA or bankruptcy approximately, and you tend to have only 2 payment protection insurance products in a bankruptcy. Strangely, the stats seem to be showing them to be of a higher value of around £2,500. So go figure that. So, that should help you. In conjunction with the chart that you'll see on the video bulletin below this one, you've got the stats there. If you're making a decision as an insolvency practitioner whether to audit, and indeed whether to process, before you even start on the question of who and whether to use a service company to process financial payment protection insurance, hopefully you've got the data there. And as I say, I'm on the phone, I'm online, I'm on drugs, because I do feel slightly in a surreal and sort of, how shall one put it, otherworldly place, posting these video bulletins, not knowing whether or who on earth might be watching. Sometimes I look at the number of views on YouTube and I wonder whether or not, well, that's just me going back and checking the video, or my buddy or my mother watching me on video. Anyway, there you go. So that's the update on the stats. The next thing I want to say, which follows on for that, is there is this issue of, is there more? Is there something that we're missing? Are we really mining these PPI products to their full value? And are we not, as an industry, whether you're a claims management company, a law firm, the Financial Ombudsman Service, the Bank Service Complaints Processor, or an insolvency practitioner, are you in fact just taking a bite out of the apple and then throwing it and then discarding the rest? So just before Christmas, well, sometime before Christmas actually, but Christmas has been the key time for us. I've been developing a pilot project with a claims management company in which we have been challenging the legality of the compensation payouts historically that we've been receiving on PPI claims. Out of deference and respect to the claims management company, I don't want to go into the commercial, I don't want to go into the details of this innovation, if you like, but I'm happy to talk to people, not on a online in this public way, but I'm very happy to talk to people over the telephone about it. But in short, we have been battering away and badgering the Financial Ombudsman Service and the Financial Conduct Authority about the fact that we think the banks aren't paying full compensation in a not insignificant, in a great minority of substantial minority of cases, and we have issued some claims in the county court over the Christmas period. We're not trying to make ourselves unpopular with creditors, but it's kind of obviously difficult not to in this current climate. But we do feel that that the regulators and the banks are rushing through the processing of payment protection insurance and just writing out a check, and the first amount of money that hits the desk, £1,000 or £2,000 or £3,000, I'm finding that often people are cashing the check. Now look, you have to take a business view of these things, and there's no point in fighting and engaging in a time-consuming and expensive exercise over claims that are of relatively small value. But I'm talking about bringing claims and bringing fresh complaints on the back of existing successful claims on the basis that the compensation is inadequate, on of the pilot batch of 18 odd cases that we've been running. The work that I've done on this demonstrates to me that you're looking about another 50 to 100% in value of the claim. So if your claim was for £5,000, then we think that the consumer might be entitled to up to another £5,000. Or in this case, the IVA or the bankruptcy might be entitled to that. Now, if you're talking about a substantial claim, then you are talking about substantial quantities of money. And what I'm trying to do, and this brings me rather neatly onto what I'm doing as a law firm and solicitor, and what the relationships that I'm building with other people in the sector, because what we're trying to do is become a really sort of blue chip, proper boutique outfit with a law firm at its heart. And I've had the verbal nod on authorisation of my law firm at long last, Redwood Legal. So it's a matter of weeks, if not days, before I will be set up, once the necessary paperwork has come through. That's at the heart, in terms of our business model, that obviously will be at the heart of things. But I have learned over the past 3 years, having set up financial mis-selling units at 2 law firms, that a law firm is not the ideal, it's absolutely workable, certainly not the only way of processing payment protection insurance, if you're not doing it in-house. And I believe that the better model now is the one that I'm working on, where I've got a law firm, I've got a relationship with a claims management company, and I've also got a relationship with another law firm, Lambert Pugh Solicitors in Norwich. And I am therefore able to build relationships with the insolvency practitioner community. This is the model, by the way, that I've presented to the Solicitors Regulation Authority and has been approved. It's quite an innovative business model in some ways, I suppose. So I can build relationships with insolvency practitioners and really properly and truly meet their needs. I can identify whether or not it's a complex matter that needs to go to Redwood Legal, whether they may need the reassurance of a law firm, and they may hate getting text messages on their phone, and they don't like claims management companies, or they simply want the security of a law firm that's regulated by the SRA, processing their financial products and insolvency. I can then steer them in the direction of the Norwich law firm. And then if it's perhaps a larger insolvency practitioner, and I'm talking with two larger insolvency practitioners that are of interest to me, with whom I'd like to build relationships, because I like their businesses and I like the people in them, they will be probably quite prepared to send work, and will want to send work to this claims management company, which is, I was at their offices last week. They are properly geared up, and they've got the space and the facilities and the expertise to process large quantities of claims. Currently, they're processing hundreds rather than thousands, but all the knowledge is there to convert them and spin them into a relatively, not massive, but relatively decent, medium to large scale payment protection insurance processing unit. So that's the structure. And I also have a relationship, starting to build a relationship and put with another company who will be able to deal with the nitty-gritty of interest rate swaps, where it really most of the spade work doesn't need to be done by a law firm, by a specialist law firm. So that's the structure, which brings me on to this issue of interest rate swaps. Now, I do feel that I'm something of a crack record, but I think that whilst perhaps an insolvency practitioner, actually, I don't think they can. I think insolvency practitioners do have to process this payment protection insurance, but I think that interest rate swaps is potentially it's even more important that an insolvency practitioner takes an interest in whether or not any of their debtor clients has an interest rate swap, whether any of the businesses they're dealing with have been missold an interest rate swap, because I have previously I had trawled through all the materials and the law on this issue back last year. This year, I've also now met with somebody who is the second person who's processing interest rate swaps. I've now found two good people who've got background in banking, substantial background in banking, and need to form alliances with the lawyers such as myself. And I'm beginning to realise that the big thing with interest rate swaps is they are like PPI, i.e. there is some endemic dodginess, for want of a better word. Unlike a lot of other financial products out there, there is some endemic dodginess, like single premium. It was banned by the Competition Commission. That's what I mean by endemic. The actual systems themselves are corrupt and dodgy, and the way in which a sophisticated product that's really meant for the city was repackaged to try and flog it to small in unsophisticated businesses. So that I've definitely established. The next thing that I've established is that they are high value. I mean, 100,000 is a low value claim. So I think that there are issues there around. I hesitate to use the word negligence. That's probably, I don't know. Perhaps it's not too strong a word, but it's something. But professionalism is a better way of looking at it. I think that a self-respecting insolvency practitioner needs to take a professional view, and within the resources and time available can at least do something to identify the existence of an interest rate swap. And just on that second point, I think the key thing is to find someone to do an audit, whether it's me or someone within our own organisation or another or competitor of mine, and get them to obviously you're going to need to try and get hold of the original agreement, but then it really is a case of speaking to the individual, the business concerned, and gauging whether or not you feel that there has been a missale, because, and if you look at the case law on this, not every interest rate swap is missold, just as not every payment protection insurance claim has been missold. I've got clients who actually wanted a single premium payment protection insurance product. It's rare, but but it does happen. So you've got to get the agreement, and you've got to check by asking someone to do an audit, asking a lawyer or one of these sophisticated, one of these individuals that I've mentioned who've got proper experience of the sector and are probably working with a lawyer. Don't go lightweight on this one, please, because I've spoken to people who are clearing up the mess created by claims management companies that don't know a bugger all about interest rate swaps and tried to process them on behalf of people. So the other thing to say about interest rate swaps is make sure that you are not going to fall foul of limitations. Now, people will tell you a lot about limitations. I've posted a video on this issue elsewhere on my site, but the thing is, I do think you should have in mind a 6-year rule and be looking at your interest rate swaps now to identify their existence, and at the very least writing to the offending creditor and saying, will you agree to stop the clock on limitations on this interest rate swap because of limitations periods. And if they're not happy to agree, you can always issue a claim. You just don't file and serve it. It's just dormant, but you've issued it to protect your position on limitations. Some people talk about 3 years. There's a long stop action on a specialty, 12 years, but 6 years is a good, I believe, good figure to work out in terms of limitations. Okay, that's interest rate swaps. And finally, I was talking earlier about innovation. I think this is especially true of interest rate swaps. You want to make sure that you're getting proper compensation, needless to say. And I think of the claims that have been settled, there's certainly a reasonably strong argument to say of the few that have been settled, the amounts have been relatively derisory. So that brings me on to the fifth point, which is, you'll be pleased to hear a brief one, which is to simply to conclude by saying that don't be in a position in a few years, 6 years time, looking back at either having poorly processed financial products in insolvency. And look, you kind of have to trust us on this. Some some insolvency practitioners, they've done their own thing. They've sent out hundreds or thousands of letters to the consumers. Trust us on this. At least have a conversation. That's not going to work. Some have done it in-house. Well, fine if you can do it in-house, but make sure you've got, you have taken some time and you have done a proper job in finding someone who can properly process the stuff. It's not just about sending out letters and then complaining to the Financial Ombudsman Service. So be careful about that. And indeed, I don't really want to work with insolvency practitioners who do just want to kick this problem over there. I want to work with insolvency practitioners, who want to, be top of their game in their sector, I suppose. So don't be looking back in a few years' time saying that you tried to do it yourself but you did it half-cock, or that you sent it to a claims management company. I've spoken to a few, plenty. My brother's certainly spoken to plenty who have sent their work out to a claims management company. Don't park the problem in that aren't experienced. Don't park the problem in that way, because it'll just come back to bite you in the bum. And finally, on these interest rate swaps, I really do think you need to get onto them now, because they're high value, there has been dodginess, and there are limitations issues. So I feel like a matron talking to a bunch of school children. That's probably a reflection of the fact that I went to a public school and a prep school, boarded most of my life, and anyway, so consider your knuckles wrapped by matron on this issue. You don't need to do a lot of work to just, address things now. CF the interest rate swap letter asking the offending creditor, stop the clock on limitations to buy yourself time. Okay, folks, many thanks. You can see more on the discussion group, PPI and Insolvency, linked to the discussion group that my brother has going. My brother's now given a lot of work to this law firm in Norwich, is now moving over to work more closely with Redwood Legal, with a claims management company in Oakham. So that's the news on that. So I wish you a relatively very prosperous and a relatively hassle-free and headache-free new year.